Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And what do you know? It's January 18th. And today, Purpose Investments just launched two brand new covered call ETFs, part of their yield share suite. So as we know, these yield share ETFs, these are ETFs that hold only one stock, a single stock, but they give you yield because they write covered calls on that stock, and they also use 25% leverage. So they recently launched Nvidia and Microsoft to their existing family. You see the stock symbols right here. So now, if we look at the main landing page, they have Nvidia, they have Microsoft, brand new, just launched today, along with the other existing ones, Tesla, Amazon, Apple, Google, and Berkshire Hathaway. So very, very cool, everyone. And as we know, these ETFs only have access or only hold one stock. And they write covered calls on it to give you some monthly yield, monthly distribution yield here. You see that in the key benefits in this article. So the main problem, if you're an income investor like me and you like these stocks like Apple, Microsoft, Nvidia, Tesla, the problem is they don't really have dividends, or they have a really small dividend. So this is a great way to get access to some of your favorite stocks, very high quality stocks, and get monthly income. And that monthly income is coming from the covered calls that they are writing on the portfolio. So you get monthly income. Of course, you get growth potential, right? Because it still follows that particular stock, whether it's Microsoft or whether it's Nvidia. Also, you could buy these ETFs. They are Canadian listed, so you're buying them in Canadian dollars, so you don't have to worry about any currency conversion if you're Canadian. Reduce volatility. This goes with all covered call ETFs. When you're writing an options or covered calls, you're really cushioning against a decline in the stock price. That's why you get lower volatility or lower risk. And tax efficiency, of course, because all the yield that's generated with these covered calls is in the form of capital gains. It's not regular income or eligible dividend income. It's capital gains, which, as we know, is taxed 50% better than regular income. So lots of advantages, pretty cool here. So now they have 7 ETFs with the Nvidia and Microsoft one just launching today. So you could see they actually declared the first distribution, so you could get a sense of what kind of yield you'll get. Of course, remember, these monthly distributions can vary, so your yield could vary. But the Nvidia one, a little over 10%, pretty cool, because Nvidia, it is a fairly volatile stock, and definitely not as volatile as Tesla. But as you know, or in case you didn't know, the yield you could generate when you're doing a covered call strategy really depends how volatile the stock is. The more volatile it is, the more richer or higher the options premium are. That's why you can see the Tesla one, very high volatility. You have over 20% yield right now. So Nvidia, not as volatile as Tesla, but definitely more volatile than Apple and Microsoft. So you get a little over 10% yield right now with Nvidia, and a 6% yield, approximate 6% yield rather, with the Microsoft one. So very exciting stuff here, guys. And the management fees, by the way, they're the same for all 7 of these ETFs, 40 basis points, which is actually quite low for a covered call strategy. So I have to commend Purpose for keeping that management fee low. I know you're going to ask me, what is the MER, however, and we won't know until after a year of these ETFs are out. But if we just look at the MER of the Tesla one, which has been out for a year, you see 0.58 or 58 basis points. The Apple one is 52 basis points. So that should give you an idea of what the MER will be for the Nvidia and a Microsoft one. So it's enough talking now. Let's actually talk to the man himself, Mr. Nicholas Mersch, who's actually the portfolio manager. I always love talking to the people who are actually managing these ETFs. We will ask him some important questions like, why Nvidia? Why Microsoft? Why did they choose these 2 stocks in particular? Are there more coming? Is there an all-in, now that they have 7 in their family, is there an all-in-one style purpose yield share ETF coming? And we'll also discuss the very important thing when you're looking at any covered call ETF. We'll reiterate and we'll talk to him again about the covered call strategy that Purpose uses on these ETFs. So let's get to it. Hey everyone, I'd like to welcome back our returning champion from Purpose, Nick Mersch. Nick, so glad to have you back on the channel. You are a portfolio manager from Purpose, been on the channel before. How's it going, my friend?
It's going great. Thanks so much for having me. Really appreciate it.
Yeah, appreciate you coming on because it's always exciting when Purpose launches more yield shares. You're launching two new products. I'm always excited when there's more income oriented funds out on the Canadian market. So you guys are launching yield share, Microsoft and Nvidia. So the Microsoft stock symbol is MSFY and the Nvidia one is YNVD. So this is your number 6 and 7 to your yield max suite. You now have 7 total, hopefully more to come. So first question, of course, why Microsoft, why Nvidia? Why did you guys decide to go with these two stocks in particular?
Yeah, for sure. And thanks again for having me on. Always love chatting with you and really talking about this exciting sort of really new innovation that we're putting out into the market. And we've had some great success with our yield share products to date. And we really believed we really needed to further expand our lineup to better serve our clients. And we noticed that there was a lot of retail favorite names that were very attractive, and we've been receiving a lot of great feedback around. So we decided to add two more US names to this product suite. And we picked NVIDIA and Microsoft. And we picked these names for several reasons. So the first is that we really do believe that these two companies are at the precipice of a long-term secular wave that is really coming around artificial intelligence. And AI is no longer something that is sort of done in this black box behind closed doors. And broad-based commercialization of this technology is really ushering in this next compute cycle. And we continue to unlock this new way of thinking. And these two companies are really spearheading the charge. And we saw just how impressive the data center revenue ramp up has been in Nvidia, really a lot of blowout, incredible quarters there. And we're also seeing Microsoft take over market cap, the leaderboard top spot from Apple lately. And I think both of these companies are just getting started. And we also plan on being around for quite a while with our yield shares product. We think both of these stocks have great exposure to this long-term staying power. Now, remember, because our product is a partial coverage strategy, only 50% of the NAV, our yield shares are much better at tracking that long-term total return profile. And this is because we don't give away as much upside. So while other covered call strategies and these other products might print some sort of shiny yield number on the brochures, you also have to think about the total return profile over the longer term when it comes to these long-term secular themes. And that's the core concept that we've really built our product around, that total return with a nice monthly yield. And we think that's the perfect combo. We also think that these two shares, another reason that we've picked them is that they have incredibly deep options market,
Yeah.
both NVIDIA and Microsoft. So we're able to farm yield much more efficiently. And we can touch on that in a little bit.
Yeah, for sure. So I was gonna ask you questions regarding that. You put a lot of great information in there. So yeah, I mean Microsoft, Nvidia, two big players coming up in that whole AI market. Nvidia, everyone needs those chips, right? Even things like AMD, they've been skyrocketing. Microsoft always been a really top player. Another thing you mentioned is the deep options market. So we'll talk a little bit about the cover call strategy in a little bit. First, I just want to ask you, and I know you can't discuss future launches, but are you guys thinking of other yield share products related to AI related companies in the future?
Yeah, and I think it is really easy to get so excited around this AI. And I think if
Yeah.
you were playing around with ChatGPT like I was, it's always really interesting when you have these technologies come to market. And something that always stuck to me is when a tech product is truly great, it's indistinguishable from magic. And I think that's what's going to happen here with a lot of this AI. But it is easy to get sort of wrapped up in the hype around it. So if you think about Microsoft, it's got many other business units that all
Yeah.
work in tandem with this AI investment cycle, whether it's their kind of cloud or productivity suite. And it's really able to fund this growth through its incredible free cash flow profile. NVIDIA, on the other hand, you can really look at this as that high beta play that's going to have a lot higher risk, but higher reward if this capex cycle really does continue to accelerate. And we think these two stocks are really that perfect barbell approach for exposure to AI. So at the moment, we're really focused on these two players with the most direct exposure, but don't forget about our other products. We also have Google, Amazon, and Tesla,
Yeah.
which are all making very solid advancements in the AI space, whether it's the hardware components or the backend cloud infrastructure as well. And I think in past investment cycles, the incumbents have really been disrupted. So if you think about sort of the innovator's dilemma and disruptive innovation, it's usually those guys that are sitting comfy at the top that really get threatened. But I think the mega cap this time around will have will be much faster to deploy capital towards AI companies and even venture capital in this space this time around. They also have the advantage of massive data moats, which can really be leveraged on both sort of the training and inference side when it comes to building out these more robust AI models. And I think this is one technological revolution where I think the mega caps can further widen this gap, which fits perfect with our product suite. So over the short term, we are remaining focused on these yield shares that we have launched to date and are very excited about launching these two new ones, not only because we love that long-term area that they play in, but also because we're able to much more finely tune our option strategy around these particular stocks and the depths of their options markets again. And we're really incredibly excited about launching these two ones over both the short and long terms in terms of the prospect that they have as companies.
Yeah, absolutely, absolutely. So you touched on it a little bit. I'm going to ask you, of course, this is the passive income channel where it's all about the income. So are these two new ones? I heard you already say it, but if you could confirm, same strategy as the other yield shares, which is basically long exposure to the stock, 25% leverage, and options, or you're writing those covered calls on up to 50% of the portfolio. Is that correct?
That's exactly right. And the reason we do this is, again, to optimize that total return profile while generating very attractive monthly yield. And I think now would be a pretty good time to dig a little bit deeper and just exactly how this option strategy works. So our proprietary option strategy typically has anywhere between 10 and different legs of options underwritten around different maturities. And we're writing in strategic areas where we think the implied volatility is mispriced. So our proprietary model mixes sort of the proper combination of yield farming while participating in that long-term return profile by not giving away too much of the upside. And we also avoid path dependency when it comes to single day events. And that's that all the different legs that I had mentioned in terms of 10 to 12 different maturities. So we're not overly exposed to any single day risk events such as CPI print days. We all know how exciting those get these days. And now with all the rate hikes coming up around FOMC meetings, there's going to be, I think, a lot of volatility, which we'll be able to very effectively farm with our yield strategy. Now, we do say up to 50% because we want to be very cognizant of trading costs on top of that. So at certain times, we're going to let it trade around different bands. It might get down to 45. It might get up to a little bit over underwritten, but we stay within that band in order to limit our trading costs while having a systematic approach in terms of our yield farming strategy. So this on the back end really combines a lot of these different sort of attributes into one easy to use product. So let us farm the yield, and we can do that for you in terms of making sure all these options contracts are getting rolled into the proper dates, and we're doing that all in one easy to use product.
Yeah, that's great. And Purpose has, it's one of my favorite option strategy. I love when you guys use that 25% leverage. It just boosts everything. And then if you're doing it up to 50, you're not giving up. You're capturing most of that upside. And the proof is in the pudding. I mean, if you look at YTSL, that's been just celebrated its 1 year, as well as the other yield shares. I was actually pleasantly surprised to see that it really matched very, very closely the performance of the Tesla. And that's actually pretty rare for a covered call ETF. Typically underperforms, especially if the underlying does really, really well. So you do, I think it's a good strategy because it's like you said, a perfect balance where you're still getting exposure to that stock, but you're getting that yield. So of course, my next question is, and I know we discussed this before, but many people are always going to have this question: why get the yield share? Why not just buy Microsoft stock or Nvidia stock or Tesla stock instead? What would you say are the main advantages of getting a yield share versus just a regular stock?
Yeah, absolutely. So I think someone should own yield shares if they're looking to really earn rent while housing their favorite stocks. And yield shares really enhances the yield that they're generating in that portfolio and adds that component of the monthly distribution to investors that are looking to generate income on top of it and have that characteristics of some cash flow coming in the doors while still appreciating really on that upside. And we found that investors typically shift a portion of their single security positions to purchase yield shares. They kind of watch how it trades for a little bit, and then as they sort of see how the product has performed and how the characteristics of yield are really having that added boost and changing the general characteristics of their portfolio, they start to shift more and more of their individual stock holdings over towards the product. So we do encourage you to, hey, come give it a try, watch how it trades, and really let us show you just how well this performs in any portfolio, and is really a great sort of income booster to every investor's toolkit.
I could definitely attest to that. I mean, I have personally YTSL in my portfolio. It's definitely the highest yield. I have over 20% yield. It really brings up the level of income in a portfolio. I mean, I'm fully an income investor, but maybe some people are not, and they have like a 3-4% yield overall, and
Hmm.
just getting a little bit in some of these yield, the yield shares really helps boost that portfolio
That's
overall.
right.
Overall, it's absolutely incredible. So now there is some competition in the US or some similar products in the US called Yield Max, single stock. They're not leveraged, but they do covered calls on it. And I don't know if you saw this or not, but they recently launched their all-in-one funds of funds. It's called the YMAX. It basically combines all their single stock Yield Max ETFs, 18 total, all in one. So now that Purpose has seven of them, are you guys thinking about launching or doing an all-in-one product? Or you're thinking of maybe let the do-it-yourself investor just pick and manage that on your own? What's your thoughts on a style of all-in-one type of yield share ETF?
Yeah, for sure. So we have had inbounds about putting baskets together with several of these products. But right now, what we're really laser focused on is providing yield shares as a tool that every type of investor can use however they please. And we've had some stories of investors combining several of our products themselves to form custom baskets
Yeah.
in order to match yield around total return profiles for a little bit more diversified outlooks. But right now, we are focused on yield shares as individual products because this really does allow us to narrowly focus on what make yield shares so great, which is our yield farming strategy and our proprietary option strategy overlay, while providing a lot of flexibility for investors to make their own call on just how they want these products to fit within their own portfolios. So we're not making you buy a basket of these stocks in any sort of specific industry at any sort of specific yield levels. You can sort of tailor the exposures exactly how you want within whatever works for your portfolio. So that's why we are focusing right now still on that single stock product. But maybe in the future, something like a basket could make sense. But for now, we're really about focused on arming the investor with these tools in order to create their own baskets.
Yeah, makes sense. That's awesome. So, last question. I don't want to hold you for too long, Nick, but my audience, this channel is all about income investing. I noticed that throughout the year, the Tesla one, even the Amazon one, has increased their monthly distribution more than once. So, can you give us just an idea on what makes you decide to increase or maybe decrease the monthly distribution of these funds? Is it the net asset value going up? Is it really all just about the volatility going up, so you're harvesting more? What makes you decide to raise the distribution? Maybe we could stick with the Tesla one as an example. So
Yeah, for sure. So whenever we change our distribution strategy, and we do want to outline this as one of the features, is it is flexible around implied volatility of the underlying. So the option strategy that I had outlined there is what we
Mhm.
take about 30 days maturity out in between 0% and 5% in between at the money and 5% out of the money calls. And we sell and we write options around those strategies. So those distributions that we're able to generate from our call writing strategy are going to vary around periods where implied volatility of the underlying stock changes. So as we're able to pick up and farm more effectively these implied volatility periods where we are seeing temporary upticks, that's
Yeah.
when we're able to be a lot more strategic and really be aggressive in our underwriting strategy and actually generate a lot more income for the fund structure itself than we are paying out. And if there's a sustained period of that, what we'll do is we will increase or decrease. It can work both ways in lower volatility environments too. But we do have them around general range. And the way that we're structuring them in terms of our maturities is it's never going to be a massive swing. So these changes around those bands are going to be widely determined by the implied volatility of the underlying, in which we can increase and decrease our dividends to really be able to provide that monthly yield while again focusing on that total return profile.
Awesome. Yeah, I mean, cover call strategy, option strategies, it's basically all mostly based on volatility. And last question, I'm thinking of more as I come because I'm pretty curious. Do you guys typically do like weekly covered calls, monthly covered calls, a combination of the two? Some, the competitor in the US does a weekly one. So what's your view on you talked about out of the money, up to 5% out of the money. What about the duration? Weekly, monthly, combination of the two?
Combination of the two. So we do both
Awesome.
weekly
Okay.
and monthly, and the average maturity from our laddered strategy is about 30 days. But we found that by being strategic in terms of the timeline, whether it's 1 week, 2 weeks, 3 weeks, or up to 6 weeks, then we can really pick parts of the volatility curve where we think it is mispriced on a relative basis. And that's why we've been able to be very strategic in terms of picking up yield where other people might not be able to spot sort of these trends that we're seeing. And that's why we've been able to increase distribution across some products. But again, keep in mind, just as we've seen some increases there are going to be those periods of lower volatility where you could see the yield and the distribution come the other way. But what we're trying to do is really farm on different areas of the options market in order to optimize that yield.
Awesome. Yeah, I like what I'm hearing. I mean, I always like when the options manager it's active, it's an active approach, always looking at it, different legs, different strategies, different time
That's
frames.
right.
I love the 25% leverage. One of my favorite styles of option strategy. So Nick, once again, thanks so much for being here. Looking forward to these two new ones and more. Of course, I'm sure you'll enhance your suite going forward, and we'll have you back on. So thanks again for being here, and take care, my friend.
Thanks so much for having me. Always a pleasure to talk to you. Take care.
Take care.